Welcome to the debate. Today, we're dissecting a thesis that is, well, it's as unsettling as it is compelling. We are breaking down The Architecture of Anti-Fragile Wealth by Dr. Pooyan Ghamari. And the central premise here, it really cuts through the noise of daily market fluctuations to ask a much bigger question. What if the financial era we all grew up in, the era of the 60-40 portfolio, predictable central banking, stable borders, what if it isn't just paused, but is actually extinct?
It is a heavy proposition. The text argues that we've transitioned into a world where capital no longer lives safely in a bank vault or a mutual fund, but it must exist inside algorithms, energy grids, and decentralized networks just to survive. But the question we need to wrestle with today is really the cost of this transition. Dr. Ghamari proposes that to survive, investors must evolve from being passive buyers of financial products into active builders of these, incredibly complex systems.
And that is the crux of it. The core question isn't just about where to put money, but what money.
What money is in this new context. Yeah.
Exactly. I'll be arguing that the old maps are genuinely broken. The thesis here is that investors who don't aggressively adopt decentralized strategies, physical AI infrastructure, and jurisdictional mobility are essentially sitting ducks in a shooting gallery of currency devaluation and policy errors.
And I'll be approaching this from the other side. While I agree the ground is shifting, anyone looking at inflation numbers or geopolitical tension can see that. I am just not convinced the solution is as binary or, frankly, as accessible as the text suggests. The requirement for an individual investor to suddenly master encryption, energy grid dynamics, and international law, it places a potentially unsustainable burden on them. We might just be trading market risk for execution risk. If you try to build your own bank and you fail, there is no FDIC to call.
A fair warning. But let's look at the alternative. Let's get into the position statement here. The classic portfolio, the 60-40 split of stocks and bonds, was built on comfort. It assumed that when stocks went down, bonds would go up and protect you. That model assumed history was a reliable narrator. But the source material makes a devastating point. Prices are no longer signals alone. They are often reflections of policy experiments, algorithmic feedback loops, and political theater.
I did find that phrase, prices as political theater, particularly striking. It really suggests the ticker tape isn't telling you what a company is worth. It's telling you what the central bank is doing that week.
Exactly. It's the reality. When central banks rewrite the meaning of interest rates, the 60-40 mix becomes what he calls a house built on moving ground. My position is that in a world where machines make trading decisions at speeds that turn human analysis into background noise, the only safety lies in architecture. We need systems that are anti-fragile. And to define that term clearly, fragile things break under stress, robust things resist stress, but anti-fragile things actually gain strength from stress.
Right, the concept popularized by Nassim Taleb, which Dr. Ghamari is applying directly to asset architecture here.
Precisely. The text argues that to achieve this, you must move capital into decentralized networks where the rules are visible and not subject to the mood of a central banker. It means owning the physical infrastructure of the future economy, not just the paper derivatives of the past. It means structuring your life so that chaos in one jurisdiction doesn't wipe out your entire existence.
I see the theoretical appeal, I do, and the text certainly supports the idea that the classic portfolio is dead. However, let me give you a different perspective on what is being asked here. The text explicitly states, this environment asks more of the investor. It says capital allocation has become a creative act.
Which is a positive development, is it not? Agency over passivity?
In theory, yes. But in practice, the text warns, and this is crucial, that delegating all of this to intermediaries leaves the investor blind. That implies that unless an investor becomes functionally literate in semiconductor design and data governance, these are incredibly technical fields. They aren't actually safe. They are just lost in a new, more confusing forest. My position is that while the diagnosis of instability is correct, the cure requires a level of sophistication that borders on the impossible for most. We have to ask if this shift to being a builder is actually a trap for those who lack the precise expertise to execute it.
I think you're underestimating the capacity for adaptation. But let's get into the core of the debate. Let's talk about these old maps. The text describes the traditional investor as a passenger in a vehicle they no longer control. And that, to me, is the fundamental risk today. You mentioned the burden of knowledge, but consider the burden of ignorance. If you're holding a portfolio of sovereign bonds in a high-inflation, high-debt regime, you are relying on a map that leads right off a cliff.
I'm not defending the 60-40 split as some vibrant strategy for 2025 and beyond. No. We can agree that the sensible home of the past is gone. But let's look at what the text proposes as the replacement. It argues that value appears at the border where ethics, design, and automation meet. Now, that is poetic, but let's break that down practically. You're suggesting we abandon trust in institutions for what, exactly?
We abandon trust in political moods for trust in visible rules. This is the anti-fragile concept applied to finance. The text highlights this traditional banking relies on rules that can change overnight. Capital controls can be imposed. Withdrawals can be limited. We've seen this happen globally time and again. A well-built, decentralized network, DeFi, it relies on mathematics and open participation.
But mathematics in this context isn't just 2 plus 2. We are talking about smart contract risk, bridge hacks, massive regulatory crackdowns. When the text says trust in math, it's asking the user to trust code they very likely cannot read.
But the rules are visible. That's the key distinction. Even if you can't read every line of code personally, the code is open source. It is auditable by the entire community. When confidence in authorities erode, open networks become more valuable because they are transparent. The text says some systems weaken under pressure while others gain strength from it. A decentralized protocol doesn't care who the president is. It doesn't care what the Fed chair says in a press conference. It just executes logic. That is anti-fragility.
I'm sorry, but I just don't buy that entirely. Code is written by humans, it has bugs, and more importantly, the interface between that code and the real world is messy. The text warns that learning is not decorative. It demands engagement with encryption. If you lose your private keys, the password to your wealth, that wealth is gone, forever. There is no forgot password link in the architecture of anti-fragile wealth. That isn't just a technical hurdle. That is a psychological cliff.
That is a feature, not a bug. It enforces responsibility. It returns sovereignty to the individual. We have become far too comfortable outsourcing the safety of our labor to third parties who do not have our best interest at heart.
It enforces catastrophic consequences for minor errors. But let's pivot to the tangible assets mentioned, because I think this is where the thesis is most grounded, and perhaps where we can find some common ground on the what, even if we disagree on the how. The text isn't just about digital coins, it talks about the skeleton of the next economy.
Yes, and this is where the thesis becomes incredibly robust. The headlines, they focus on AI applications, the chatbots, the image generators. But those age quickly. The text argues the durable value sits underneath: computing power, specialized chips, energy systems, and the cables that move data.
That's a compelling argument. But have you considered that this is essentially a return to commodities investing? I mean, we're talking about materials required for electrification and secure energy storage. The text itself admits physical resources remain essential. So are we really seeing a new architecture or just a shift in which commodities happen to be scarce?
It's not just a shift in commodities. It's a shift in utility. We aren't just hoarding copper in a warehouse. We are investing in the substrate of intelligence. The text makes a profound point. Applications age quickly. Foundations last. The investor who buys the hot AI software company is gambling on a fad. The investor who owns the energy grid powering the data center is owning the toll road for the next century.
I agree that the pick and shovel strategy is sound, but the text frames this as wealth designed for turbulence. My concern remains on the execution. Identifying that secure energy storage is vital is one thing. Successfully allocating capital to it without getting wiped out by regulatory changes or technological obsolescence in battery chemistry is another thing entirely. The text says prediction loses its charm, but aren't you predicting that these specific physical infrastructures will remain the bottleneck?
We aren't predicting the winner, we are predicting the necessity. We know the demand for compute is exponential. We know the grid is fragile. Betting on the reinforcement of the grid isn't a gamble, it's recognizing the bottleneck. The text calls this the border, where ethics, design, and automation meet. You aren't betting on a specific brand of battery, you are betting on the physics of energy transfer required for the next leap in human productivity.
I want to go back to that trust in math versus trust in institutions point you raised earlier. The text makes a heavy distinction there, and I feel like we glossed over the DeFi aspect too quickly. The text essentially argues that traditional banking is a calm age relic.
It's the crux of the argument regarding storage of value. Traditional banking relies on trust in institutions and on rules that can change overnight. We saw this in 2023 with the regional banking crisis in the US. We see it with capital controls in various nations. The rules change when the system gets stressed. That is the very definition of fragility.
True. A bank run is a crisis of confidence.
Exactly. In a decentralized network, the rules are immutable, or at least the process for changing them is transparent and codified. When confidence in authorities erodes, these networks often become more valuable. It acts as a hedge against the incompetence of centralized planners. It is the only asset class that doesn't rely on a CEO's promise.
I grant you the philosophical superiority of that model, but let's look at the user experience. The text warns, delegating all of this to intermediaries leaves the investor blind at a moment that requires clear sight. This is the part that haunts me. The old world had intermediaries, brokers, bankers, lawyers, who absorbed the complexity. They were the shock absorbers. If the new world requires me to personally verify the cryptographic certainty of my assets, I am essentially taking on a second job.
But that second job is the price of sovereignty. The text is brutal but honest. Choosing products from a shelf is no longer enough. If you want the returns of the new era, you cannot be a passive consumer. You have to understand how the system functions.
Understanding how systems function matters as much as understanding balance sheets. That's the quote from Dr. Ghamari.
Exactly. And I would argue that is a good thing. The passive investing boom of the last 20 years, the rise of ETFs and index funds, it made us lazy. It made us think yield was a birthright. Now, yield is a reward for understanding complexity.
Or it's a lure into a trap of complexity. But let's move to the third pillar of this thesis, which I think is the most radical and potentially the most disruptive: jurisdiction as a tool.
Personal geography. This is fascinating. The text argues that portions of wealth can now exist beyond any single territory, controlled by keys instead of permits.
It sounds like a spy novel. It sounds like something only the ultra-wealthy can even worry about.
It sounds like reality for a global citizen. For centuries, birthplace fixed destiny. If you were born in a failing economy, you failed with it. If your local currency collapsed, you starved. Digital networks have loosened that grip. The advocate for anti-fragility has to look at jurisdiction, not as a fixed state, but as a diversification strategy. You diversify your stocks. Why on earth wouldn't you diversify your political risk?
The text uses Switzerland as the primary example: consistency, respect for ownership, and a refusal to join every quarrel.
It's the definition of anti-fragile. By refusing to join the quarrel, you don't expose yourself to the fallout. The text suggests we need to apply that Swiss mindset to our digital lives. Neutrality means equal rules for all participants.
But here's my issue with the jurisdiction as a tool argument. It assumes a level of mobility that most people simply do not have. Mobility provides exits when rules turn hostile. That is true. But family, community, language, culture, these are sticky. You can't just upload your life to the cloud. If the thesis requires me to be ready to flee my home country, that's a very high bar for wealth preservation.
You don't have to upload your body to the cloud to upload your wealth. That's the nuance the text drives at. Residency and citizenship have also become choices rather than accidents. You can live in one place, bank in another, and hold your digital assets in a decentralized custody arrangement that exists everywhere and nowhere. You are decoupling your physical location from your financial safety.
A thoughtful structure blends legal residence, physical security, and distributed custody. It sounds elegant. But the text also warns, taxes matter but cannot be the only compass. I worry that listeners will read this and think, I need to move to a tax haven and buy Bitcoin, ignoring the warning that stability, rule of law, banking reliability all weigh on the scale. If you move your wealth to a low-tax jurisdiction that has a coup next week, You haven't built anti-fragility, you've built a disaster.
That's why Dr. Ghamari emphasizes design. It's not about fleeing, it's about structuring. The purpose is not escape, but resilience. That is a critical distinction. We aren't running away. We are building a structure that can continue under many conditions rather than only under one friendly scenario. The old map assumes a friendly scenario, that the government is competent, the currency is stable, the banks are solvent. The new map assumes turbulence and designs around it.
I agree that resilience is the goal, but let's talk about the specific warning regarding haste. Because for all this talk of urgent change, the text puts up a big stop sign. It says delay increases vulnerability, yet haste breeds costly errors.
A classic tension.
It is. The advocate in you wants to move fast because the old maps are burning. But the dissenter in me looks at the line, education precedes movement. How long does it take to get educated enough to manage your own keys, understand semiconductor supply chains, and navigate international tax law?
It takes time. Small positions grow as comprehension matures. You don't bet the farm on day one, but you have to start. The risk of doing nothing is now greater than the risk of learning. If you stay in the 60-40 world, you are guaranteed to lose purchasing power in real terms due to monetary debasement. If you start learning about DeFi and energy grids, you might make a mistake, but at least you're moving toward the solution.
Progress favors steady construction over dramatic gestures. I think that's the most grounded piece of advice in the whole document. It refutes the idea that this is some get-rich-quick scheme.
It's a don't get poor slowly scheme.
That's an interesting way to put it. I think the text suggests that the era of getting rich by simply riding the wave of global growth is over. The tide isn't rising for everyone anymore. Now wealth preservation is an active, defensive, and constructive job. So let's bring this together. I mean, the great synthesis, as the text calls it, claims that anti-fragile assets, deep understanding, and jurisdictional design form one system. You can't just do one.
Exactly. If you have the assets but in the wrong jurisdiction, they can be seized. If you have the jurisdiction but the wrong assets, like a failing fiat currency, they inflate away. And if you have both but lack the deep understanding, you'll likely get scammed or lose your keys. Each strengthens the others. Knowledge guides allocation. Allocation shapes jurisdiction. It is a feedback loop.
Empowering, yes, but also terrifying. I'm just not convinced because it assumes everyone wants to be an architect. Most people just want to live their lives. They want their wealth to support their life, not be their life. This thesis suggests that to keep your wealth, it must become your primary intellectual focus.
But isn't that the reality of what he calls the new industrial era? The text says, wealth is changing its shape with the force of a new industrial era arriving all at once. When the Industrial Revolution happened, cottage industries died. You couldn't just keep weaving at home and expect to survive. You had to adapt to the machine age. Now we have to adapt to the algorithmic age. The cottage industry of picking stocks based on PE ratios might just be dead.
That is a fair historical parallel. And maybe that's the bridge between our views. The factory of the future is the synthesis of AI infrastructure, DeFi, and jurisdiction. I'm just more skeptical about how many people can actually learn to operate the machinery.
So as we wrap up, let's summarize where we stand. I firmly believe Dr. Ghamari's thesis is a necessary roadmap. The old maps are leading us off a cliff. We must become builders. We must embrace the turbulence. The future belongs to those who understand the physical infrastructure behind AI and the mathematical trust of DeFi. If you are sitting in a 60-40 portfolio waiting for the world to go back to normal, you are the passenger in the runaway vehicle.
And I maintain that while the vehicle is indeed swerving, jumping out at high speed requires a parachute that most people haven't packed. The great synthesis is a compelling vision, but it is a high-risk one. The warning in the text is just as important as the call to action. Haste breeds costly errors. The shift requires that education precedes movement, and the bar for entry has been raised significantly. If you aren't ready to become an expert in encryption and data governance, you are walking into a minefield.
But we can agree on the final sentiment.
Absolutely. The purpose is not escape, but resilience.
The ability to continue under many conditions, that is the goal. Whether you dive into the deep end of DeFi or just start dipping a toe into physical infrastructure stocks, the mindset shift is non-negotiable. You have to stop assuming safety is a default setting.
And we leave the listener to decide if they are ready to pick up the tools and become a builder, or if they need to find a new way to navigate the storm.
There is plenty more to explore in this material, and we encourage you to look deeper.
Thanks for listening to The Debate.